Today we're going to look at the Guideline public company model that we've put together in Excel that makes it really easy to run a market approach for business valuation professionals. If you want to run your market approach using high quality data, this model makes that possible. So let's walk through the model. I'll show you page by page what's being done and how to run the model. But first, I want to show you how to get the model. So from the TagniFi Excel add-in in the menu, you can choose Browse Models. That'll take you out to our website, or you can just go directly to our website, which is TagniFi.com, and it's under /models, so TagniFi.com/models. From here, just type in Guideline, and it will pop up. We can click on that, and from this page, you can just download the model to your computer. From there, you can run it and pull data in for your market approach. So traditionally, this is a report and an approach that has taken many, many hours by analysts to create. Every company, if you were to create a market approach by collecting data manually for every company, I think in this example we have 12 of them, this would probably be a 3, 4, even 5-day project to go out there and pull all this data in, to check all of the data and to make sure that it's accurate. We can run this model now in less than 30 seconds just by putting in the valuation date and the ticker symbols. So it's a substantial time saver for business valuation professionals. All right, let's get into the model here. The first page is the input page. This is the only page where you put inputs in. Everything else is created based upon these inputs. The first 6 or 7 rows is going to be header information, so you could put your firm's name in here, your appraiser, the date prepared, subject company name. If you want to have an exhibit letter or number, you put that in here. And then we get into the model inputs. There are 2 dates in this model. The first is date of value. In this example, we're using 12/31/2014, and the second date is a data cutoff date. So one thing to mention here, this model to run appropriately is going to need the On-Demand Pro account. So if you don't have an On-Demand Pro account, this model is not going to work for you. So again, to use this, you need the On-Demand Pro account, and that's where we have the ability to restrict data based upon a specific date. Or backtest, essentially, it's a backtest capable plan, and for this model you need that. So for the data value, again, we have 12/31/14. That is, we're going to pull in the share price using this data value. If that data value happens to be on a Saturday or a holiday, we'll use the preceding date in this model automatically. Then the data cutoff date, this is what I like to call the time machine period. So basically the data cutoff date is going to restrict data that was filed on or before this date. So anything that was filed on or before this date will show up in the model, and it's going to use the most recent values as of this date. It's going to exclude any data that was filed after this data cutoff date. And so this allows you to determine if you want to use data that was filed on the valuation date. Using 12/31/14 as an example, if you have a company that has a fiscal year or calendar fiscal year end, and they did not file their financial statements, their 10K in this case, until after February 15th, that data is not going to show up. So there's 2 different schools of thought in business valuation. I call it the purist theory, where people who want to only use data that was available on the valuation date. In that case, you would simply change the data cutoff date to be the exact same as the date of value. There's the other school of business valuation, the known or knowable school, and they're saying that the data was generally known or knowable on the valuation date, and so for that reason, even though it wasn't filed with the SEC on that date, they still want to use the data that was filed after the valuation date. And what the data cutoff date does is it allows you to do that. So it basically gives you that window to say, okay, I'm going to use data that was filed, in this case, between 12/31 and 2/15/2015. So that's the date concept. There are, again, 2 dates, the data value and the data cutoff date. So those are what we're going to use for this model. And then we have the comparable company ticker symbols. These are a group of retailers that we're using, and as a result, it looks like we have 12 of them. So all 12 companies will be flowing through the model in subsequent pages. This is where you select the rounding. If you wanted to round the data in thousands, millions, or billions, you just change this value. It looks like we're using number 2, which is rounding it into thousands. And then two other inputs that are important to this model. We have a share price type. So if you want to use an average of an average price on the valuation date, you would change this flag or this switch to be 1. And I believe that's what you want to use for IRS valuations. If you want to use the closing price, just leave it at 0. The next switch here is include long-term investments in the market value of invested capital calculation. So we track long-term investments as a separate line item on the balance sheet, and using this switch you can determine if you want to include those long-term investments in your MVIC calculation. Changing that to 1 will include long-term investments in that calculation. And those are the primary inputs. So let's move into the review of the model. We just have a nice simple contents page so that you can use that for your report. Page 1 is where we're actually calculating the market value of invested capital. So we're showing, as of this valuation date and the data cutoff date, which periods are being used in this model. So here you have the latest fiscal year end, the latest quarter end, the shares outstanding from the latest quarter, the price per share as of the valuation date, the market value of equity. Then we're taking cash out of that, adding in debt, essentially using a net debt number to come up with the market value of invested capital. Then we're pulling in book value of common equity and total assets. One thing to note on this model is there are some expansion options if you wanted to see how something is being calculated. In this case, if we wanted to expand the cash column, we can see how that calculation is being done. So you can see it's cash and equivalents, short-term investments, and long-term investments, which all equals 0 because we have the switch off on the home page, on the input page. Page 2, we're pulling in the latest fiscal year operating data. Revenue, EBITDA, EBIT, net income. Again, you can expand into EBITDA to see how that's being calculated. Note that in our standard model, we do add back restructuring as well as special charges. And then on the right, we're computing margins for each of the comps. I'll scroll down a little bit just to show we also have some statistical data so you can see what the average, the median, the high, and the low margins are. This page, page 3, we're pulling in the same data, except this is for the previous fiscal year. Page 4, exact same layout, except we're pulling this in for the latest 12-month period leading up to the valuation date in this case. So here you can see the quarters that are being used to calculate this latest 12-month period. Page 5, we're calculating the market value of invested capital multiples. So all of these are automatically calculated for you. And again, if we scroll down, you can see the mean, median, high, and low. Page 6, we have market value of equity multiples, automatically calculated based upon all of the inputs that you provided in the input page. Page 7 is a growth rate analysis. So we have annual growth as well as 5-year compounded annual growth. Let's move on to page 8, where we have a ratio analysis. So these are liquidity ratios, leverage ratios, and activity ratios over here to the right. Again, all automatically computed. Page 9 is a DuPont return on equity analysis. So we have broken out a 3-step DuPont return on equity as well as a 5-step return on equity, so you can compare the comps that you're using as far as how they're generating their return on equity. And then page 10, we have a filing reference, so you can see which filings were used to create your report, the form type, the period that it was reporting, as well as the date it was filed, and we have a link here to make it really easy for you to go out and view that filing. Page 11, we just have a reference so that you can see which data sources are being used in this model. TagniFi Fundamentals and TagniFi Markets are the two data sources that are being used. So that's a walkthrough of the Guideline public company method that we have put together. And again, you can download this model by going into Browse Models. That'll take you out to our website. Just put in this case, Guideline, and we can download it from here. So hope that is a model that you'll find useful as a business valuation professional, and have a great day.